Good morning, everyone. Welcome to our webinar today. I hope we all are having a good weekend. And we bring to you the part two of investing mistakes today. So if you have missed the part one, which was done a couple of weeks back, please do not worry. We have the recording of the same, which is uploaded on our YouTube channel. You can visit and view the first part. Alternatively, you can message us and we can have the link shared with you as well. So let's begin today. So let's do a quick recap of what we did in the last session. So what were the first five investing mistakes that we discussed? So first one we discussed was not following a budget. For any household, for any individual, it is important to follow a proper budget and look into how the surplus can be optimized and how it can be effectively used to build a wealth or build a portfolio which is sustainable for the long run. Having an emergency fund, insurance, and doing the proper loan management are equally important so that you don't get into situations of pulling out unnecessarily from your portfolio or going for distress selling of any of the assets. So all these are important to take care of the long-term stability of your finances. And the last we discussed was following a proper asset allocation as per your age, your financial goals and your risk profile. Very important. As per your risk profile, the mix of asset classes varies, and it is very important to follow a proper asset allocation so that will take care of the market upside, downside, and give you a optimized risk-adjusted return. So today we are going to see a few more investing mistakes which one can avoid going forward. So let's begin. So losing money is not the only risk that we have to address at any point of time. So there are other risks also, like inflation risk, where your purchasing power of your money diminishes. So what is the required rate of return on your investments? Is your investment or is your portfolio able to deliver that kind of a return? So those are also some of the risks which we have to keep in mind. So the first mistake that we are going to look into today is over concentration. Like we have heard jargons like do not put all your eggs in one basket, so we diversify them but somewhere down the line when we reach a certain stage where the asset has grown in value and there is over allocation or over concentration in one particular asset class, we tend to not pay attention to either rebalancing or adjusting by adding more avenues which are contrary to to the asset allocation and things like that. So over concentration is one big risk that lot of portfolios or lot of investors face today. So it is like having too many eggs in one basket. So what happens in over concentrated portfolio is there is a failure to diversify. Uh, Either one ends up investing more in one particular asset class, whether it is a real estate, whether it is a gold, or too much allocation to equity portfolio, having high allocation to equity portfolio when compared to one's age, right? So these are all the examples of over concentration. What happens is if there is over concentration, there is loss of there is opportunity cost. The money which is being locked up in one asset class loses its opportunity to which can grow better in other asset classes given a chance. So there is inappropriate degree of risk also one takes by over concentrating in a portfolio. So this it limits your investment success because it also limits the opportunities for your funds to grow elsewhere. So let's look at one case study here where we dealt with one such over concentration in ESOPs. Okay, so we were approached by a couple who are very young and who are working for good multinational companies, and they have worked for a long period of time in those companies, and there is quite a good accumulation of ESOPs. And they had been accumulating it over a period of time because it's their hard-earned money, and the company has been growing multifolds. And this was one good approach for them to accumulate from a retirement planning perspective. But over a period of time, what happened was there was over concentration in ESOPs. In 2018 or so, this MNC is a technology based US company, and in 2018 19, in that time,
Question.
yeah.
Sorry to interrupt you. Can you please reshare the screen again?
You want me to reshare the screen?
Yes, ma'am.
Yeah, is it visible now?
Yes, ma'am.
Okay. Okay. So yeah, so what I was saying was the couple had accumulated a lot in this company's ESOPs, and in the period of 2018-19, we had done a financial planning for them, and at that point of time, the stocks were trading at a very high price. Uh, so at that point of time, also we had suggested to diversify a little bit from the accumulation, so that alternatively it grows. They have a a diversified portfolio in Indian equities also. So that was there, and they had very little allocation to mutual funds, and PF was just there. And now they had approached us at that point of time. Somehow the execution was not done. Uh, they were of the opinion that, see, when it comes to your own hard-earned money, there is an emotion attached, and especially so when you have worked hard and you have accumulated certain aspects of your portfolio like ESOPs, right? So there's an emotional attachment. So the attachment to this particular company was very high. And more so because the company was still doing quite well, and there were one thought that this kind of return, where else could I get? So the action was not taken, or they thought we can do it some other time or maybe later or something. And then fast forward to 2022, when the stocks lost value because the US markets took a hit, and they lost 50% of the value. The shares came down by 50% of the value, more than 50%. There was a drop. So that point of time, they were also contemplating with one job opportunity as well, right? So they again approached us, and we again did a financial planning. So that was the thing. So it was they were at the crossroads, like on one side the portfolio was over concentrated, and now the valuation was very low, where we cannot do anything as of now. Plus this new job opportunity was coming up, and quite a bit of work and decisions were needed to be done there. So what we did was, first we drafted a goal based financial planning for them. So where we also evaluated the new job opportunity in hand, and they were planning to relocate to another country, and things like that. So we did all that analysis of the economy of that particular country, the growth prospects for this particular company, and all of that. So they were getting a good hike in that company. So we did all of that. So the most important part, coming to the ESOPs, we again suggested to we suggested them some trigger levels based on our analysis with the investment research committee. So based on the trigger levels, they were supposed to come out 10%, 20%, and reinvest, which would build their diversify their portfolio and build a good portfolio within in Indian markets, where Indian markets may the growth is much more, like if it is, let's say, 2 or 3 times in the other markets, here it will be like 8 to 10 times growth. So the opportunity cost we can take advantage of. Even though the stocks were not trading at the 2018-19 levels, but they were still trading at they started slowly coming back to an attractive levels, where the purchase price at least could be um, uh, taken out from the portfolio. So that is the thing. So when you have over concentration in one particular asset class, one should know at what point of time you should book the profits. At least your cost price is coming out of it, right? So you can at least book those profits, come out, and look at reinvesting elsewhere. If you're so attached to any particular stock like that, maybe you can invest in it again when when they are again at a reasonable level, or when the valuations go down attractive. So at that point of so there are a lot of things one can play around with, but diversifying and de-risking the portfolio, the point of time when to do it is very important. So once the opportunity lost is lost, and now it'll take time to go back to those levels, or we don't know when that will happen, especially with the US market, since it is very, very slow there. So right, so those were the solutions we helped them with. So we created a end-to-end financial plan, evaluated the job opportunity, provided the trigger levels, the investment opportunity. So what was the value with all of this exercise that we created for them? First thing was a peace of mind, right? So at least now they know that okay, what has happened. So from now onwards, we know that how to go about it, because initially when they did, there was no goal based planning. There was no set direction. So this helped them to set a direction and how they should look at asset allocation as per their race, risk and age and things like that. So we have this reduced the overall portfolio and added other revenues in the portfolio, which can take care not only of equity asset class. We also added avenues which can take care of their passive incomes also. See, they are a young couple at the end of the time, so we de-risk some of the portfolio and put in avenues which can generate passive income from them, so they are securing their incomes, because younger generation these days don't want to work longer. So at any in maybe next 5-10 years they want to think of doing something else. At that point of time, having a passive income is a peace of mind. At least they know that 50-60% is coming to them without having to do any effort. So we had those kind of revenue. So you also, if there is over concentration in your portfolio, you should understand at what point of time you should de-risk it. You should come out of it in whether partially, or how to have a allocation in other asset classes which are not correlated to the equity markets, which can help you to withdraw from your portfolio when equities are not doing good, which can provide you a passive source of income if, God forbid, something happens to your, in the life. So life is also uncertain. So those kind of things are very important. So over concentration is one risk that everyone, most of us carry, and we have to look at ways to how to diversify it. Now, when we talk of diversifying, in some portfolios which come to us, we evaluate that there is over diversification. Like, people are confused with so many options, and, they tend to have, everything, they try to have everything in the basket. So that is also a big risk that one takes. So over asset allocation, over diversification is also not good for the portfolio. So here I like to, take a small piece from Mr. Ray Dalio's book, which is called The Principles. So who is Ray Dalio? He is a American billionaire investor, and he also owns a hedge fund. So he has written a book. So what he says is, so having so let's say, let's look at only this part which is in the square graph here. So these are the number of assets that one can have in the portfolio. And these are the portfolio standard deviations. What is standard deviation? Is the volatility of the portfolio to vary from the mean return. From the mean return, how the asset classes vary. So these are the, this is the ratio which determines. Higher the ratio, the higher the volatility, or higher the deviation from the mean. Okay, so let's say we have a portfolio of 12 to 18, 20 stocks which have zero correlation to 12 to 20 kind of assets in the basket which have zero correlation. That means they're not at all related to each other. So there you can see that the standard deviation is quite low. As you move up, as you reduce the number of assets, the standard deviation goes high. Okay, so same way. So if there is a 10% correlation and you have 20 assets, 20 things in the portfolio, so your standard deviation is somewhere here. And as you decrease the number of assets, your standard deviation goes high, right? So at the meantime, what we can also observe is that with zero correlation between the assets, one can see that there is a better risk return ratio. And when the assets are related to each other, or in the same asset classes, you see that the risk return ratio is very low. So for the same amount of risk, whatever returns you're getting is low over a period of time. And the probability of losing money, so this is very important. So the probability of losing money with having assets which have zero correlation to each other is low. So your portfolio suffer less when you have asset classes which are moving in the opposite direction, which have zero correlation to each other. For example, in my earlier webinar also I have discussed that adding, how can you hedge your portfolio for the long term? So how can you do that is by adding avenues like, gold, 5 to 10% of gold in the portfolio, having proper debt instruments in the portfolio, like having a portion in FDs, PF, which are like guaranteed, and debt portion, debt mutual funds for that matter. So now the debt mutual fund taxation has changed. Nevertheless, it provides better liquidity when compared to other asset classes. So if liquidity is a thing, you can choose mutual funds over FD or PPF. So things like that. But it is very important to have a debt portion in your portfolio. So many times people argue that the gold, you have given me one or two gold funds or gold investments in my portfolio. It has not performed only from such a long time. The debt portfolio is not performing only. So one should understand that not all asset classes perform at every point of time. Okay, it is always like that. When equity markets are doing good, the other asset classes don't perform or they show lower returns. When the equity markets falls or when there is a correction in the equity markets, you see that the gold is going up or the debt is going up. So what happens here is your returns are balanced. So you see that your portfolio has not fallen as much as the equity index when you have the other asset classes. This also helps in withdrawing from the portfolio when the markets are not doing good, right? So if the markets have corrected drastically, say 20-30%, and there is a need for you to for some goal or something has come up at that point of time, at that point of time, equity markets, it is not advisable to pull out, then because the markets are not favorable. So then what is the avenue you will go back to? You have to go back to some asset class which is performing at that point of time, let's say FD or an emergency fund, or let's say a debt portfolio or a gold portfolio. So like that. So it is very important to have a mix of asset classes which are also not related to each other. So that is what even Ray Dalio explains, that the zero correlation portfolio, the cost probability of losing money is very low. With the more the correlation between asset classes, the higher is the probability of losing money. So the bottom line is to concentrate your portfolio to about 15 to 20 stocks or 20 asset classes, which are uncorrelated to a certain extent. And what happens when I do this is I can reduce my risks without reducing my expected returns. So the expected returns can be managed with managing my mix of asset classes, right? So that is one. So now let's look at an example of stocks. Let's say we take a period of 1928 to 2013. This is again an extract from the book where I've taken this example from. So stocks, what it says is the stocks deliver the highest return over an extended period, and stocks will also suffer more significant drawdowns when they have a bad year. So now let's look at the first chart here. So let's say this is a pure stocks portfolio, and it has been invested during this period, 1928 to 2013. So the annual returns have been 9.6%. The volatility is 20%. Okay, the best annual gain is 52%. Worst annual loss is minus 43%. So you can compare this, okay, now against a portfolio which has stocks and bonds in it. So you will see that the returns are a little bit lesser than this. But what are the other aspects which are better? Volatility. You see the volatility reduces considerably because stocks and bonds are negatively correlated, right? So there's negative correlation. So on an average, the volatility has decreased, the risk has decreased. The best annual gain is 29%. Of course, the gain are also less compared, but the best part is this one. You are protecting your portfolio from the downside risk also. Not only the upside, but downside. Here, concentrating in one asset class, the downside risk is more because everything is concentrated in that particular asset class. So that is why diversification is important, but over diversification is also not good. So what are the risks of over diversification? Again, it dilutes the returns, it dilutes the performance at the end of the day, because you're not allowing the chance to, for one particular asset class to show its performance by limiting the value, by limiting the capital you're providing to that particular asset class. So it reduces the portfolio's returns without meaningfully reducing its risk. So you're taking the same kind of risk, but you're not allowing it to perform or show the returns. So there is also a tendency that because of over diversification, your focus is also lost in between all of this, because then you'll have to keep up and spend time with understanding each and every asset class, why it is performing, why it is not performing. You have to stay up to date on all the holdings within those asset classes. So it is taking away your time and effort also. At the same time, it is not giving you a proper risk adjusted return. So, what is the best way to go about this? So, if you have a over concentrated or sorry, diversified portfolio today, what you have to do is first you have to weed out the bad ones or the non-performing, whether it's mutual funds or stocks or things like that. First, weed out the things that are not adding any incremental value in your portfolio. Secondly, you have to identify the winning ideas or the winning stocks that have better growth prospects in the future. Identify which are those currently sitting in your portfolio. Okay, and then add on, rebalance it by adding the capital from weeding out the bad ones. Remove it from the non-performing ones and put it in the performing ones, so that you will have better returns and better diversification going forward. The next investing mistakes we're going to talk about is not aligning to financial goals. So what happens most of the time is we just start accumulating when we get our first job, right? We just start putting it in savings. At that point of time, we don't have a family, or we don't think of any retirement or any goal in life, and we just start doing it. Over the year, what has happened is the same practice has continued. There is no approach to look at whether my existing investments and assets are getting aligned to my financial goals. So that is one big risk and one big mistake that most of us end up doing, either knowingly or unknowingly, or without with lack of education or understanding maybe, right? So that is one thing we have to take care of. So here I would like to discuss one more case study. So we were approached by a doctor who was just returned from the UK, for good. So they are planning to settle down in India, and they have been here from the last 1 year, being employed and things like that. They have two daughters. So what is the risk they were facing was they have a lot of allocation in the pension fund. They were working in the UK, and they have moved back here. So there's a lot of amount sitting there in the UK pension fund. Yes, the retirement is taken care. There are some taxability aspects and things like that. That is another set of the problem. Another side of it was whatever investments and other things are there. Uh, about 1 crore was sitting in one mutual fund. Just one mutual fund, about 50 lakhs to 1 crore was sitting in one or two mutual funds, and a very small, stock portfolio, which was not done in a very, what do you say, the effortlessly. It was like just out of uh, just some advice or something. Some 5 to 6 stocks were there. So that is that. So there was no life insurance and health insurance after moving back to India. So the daughters are currently going to school, and the portfolio is like this. So we had to plan for their education goals, which was coming up after maybe 7 8 years or so. And they wanted to send their children abroad for their graduation and things like that. So we had to plan. So now, risk management was the most priority one, life and health insurance and emergency fund. So because we saw that there are good number of assets, there's no doubt about it, but having all of these risk management approach is also very important. So first, that was a top priority need, and we had to address that with the liquidity in hand. So we did that. Then they had good monthly surplus. So how to put that monthly surplus to use, and what can be done with the monthly surplus in hand. So that was the approach we had to set a direction for that, and how that will come is by creating a financial plan where we are having some goals, right? So children's education, retirement. So by when you want to retire, how much you want for the retirement. These were some of the questions that they had not thought about. So when I started interacting with them, I started putting questions to them. Then only then they started realizing that yes, I have to think in this direction. I have to start looking into this direction, and how can I achieve and all that. So it's like that. So planning or investing without goals, it's like shooting in the dark. I always keep saying that. So there is no direction, there is no goal. When there is no goal, you don't perform. It is like that. So let me give you another example. For example, let's say one takes a gym membership, right? A 1 year membership. The goal is to, let's say, reduce weight or be healthy or something like that. Just by taking membership will not help you achieve the goal. You have to get up, be disciplined, get up and go there in the gym, spend time, right? Whatever is required. Only if you spend your effort and time in the gym uh, for, let's say 6 months or 1 year only, then you're going to get the results. It is the same logic that you apply, anywhere else also, and in your portfolio also. You have to set a direction, you have to set a goal and be there and take that step and action, to have to see those kind of results. So that is what we did. We did a financial planning exercise. We helped them understand like what is missing and how we can do. We built the robust diversified equity portfolio. We also helped them to have some allocation to very very safer, tax efficient, and safer asset classes which can give them passive income in the future, right? So that again, they love traveling, so they want to make more time to travel once they choose to sit back and retire. So those kind of planning, that kind of a planning was done. So ultimately again here there was peace of mind, that my things are taken care, my risk is taken care, my incomes, future incomes are taken care, my children's goals are taken care with all the assets that I have in hand. Like having 2 to 3 crores in, let's say 5 crores or 10 crores in real estate, and saying that I have so much asset and I can achieve my goals, practically that is not possible. So any somewhere down the line you need liquidity, you need returns that can beat the benchmark, that can beat the inflation, that can help you realize your dreams. So that becomes very important, and tax efficiency is also one of the important things you have to consider. So always go for a goal based approach when you're looking to build your portfolio. You still have time, right? So there's nothing wrong if you want to get started even now. Re-looking at things, maybe realigning is one exercise. You should, sit with your advisor and do it. A good advisor will help you craft a plan. So why? So this slide I had used in my previous webinar also. So why we suggest, having diversified things, because equity, it gives so such a nice returns over the long period. If I'm a long term investor, why not I do it in, equity and things like that. See, like I was saying, right? So what if, there are market corrections like this and this, and your goal or your withdrawals are coming somewhere in these years. So what are the other avenues you can look at, where you can pull out from, right? So that backup you need to have. For that backup, you need to have other avenues which are negatively correlated, in your overall portfolio basket, right? The next investing mistake is timing the market. So there's no person on earth who can perfectly time the market for sure, right? So this is something which we have to, study and, understand that the time that we spend in the market is much more important than timing the market. And we don't know at what point of time exactly we can enter the market, exactly we can come out of the market. So in a short term basis that might work for, people in speculation and trading, that might work and they might look, tend to make good money out of it. But that is something on a short term and speculative basis. But when a person has some goals and, there is a required rate of return that one is trying to achieve, like let's say 12%, 14%, then a disciplined and systematic and scientific approach always helps. And the most important is, like I was saying, for the gym membership, right? Your time in the market is something that matters a lot. So let's look at, this cycle. I'm sure most of you must be aware, but for people who are, new to understanding things, so let me put it this way. This is the cycle that, a market always goes in the cycles, the equity market, the economy, or whatever it is. So there's always a peak. There's always a peak. Then there is some, fall or recession or something, right? The markets go down, and then there is a trough where the markets hit a all-time low, then the markets hit a all-time high. So all these keep on happening and repeating in the markets, in the economy at any point of time. Everything, there's a business cycle also. In business, there is something called as a business cycle. The same thing happens, right? In economy also, it is called the economic cycle, and this is a market cycle. So usually what happens is, for people who are trying to time the market, what they do is, when the markets are doing very good, right? They feel the urge or the greed to enter the market. अरे market बहुत अच्छा कर रहा है, अभी चल के invest करते हैं. So they will start investing at that point of time. So which should be the other way around, right? When the markets are not performing, that is when you should use your liquidity. When you have booked profits from your asset classes and you have held it in liquid, right? So that is the thing you should be using to invest when the markets are not doing good. So this is what happens, like when the markets are at all time high, people feel like investing there, and suddenly you see that they see that after certain point of time, once the all time high has reached, it is always the correction has to happen, and it starts happening. Then they start panicking. Then the panic selling of your selling happens, let's say at this point of time. Then again after some point of time, the markets start moving a little bit up. So they have lost the thing there, right? So then there's upside. Then maybe there's another very steep fall and things like that. So there's no way one can time the market. So a lot of people have burned their fingers and learned their lessons the most expensive way by trying to time the market. So what is the best approach is to stay invested, disciplined in the market. I get asked by my clients, sometimes markets are at all time high. Should I stop my SIPs or STPs for the time being? When there's a market correction, we can again look at, doing that. So we say that no, we have already set off on that journey, right? So let's say, take an example of a train or a bus journey. So when we board the train, we have taken the ticket. We don't get down anywhere in between, even if the driver is taking a little different routes because of the weather condition, or the tree has fallen or something. We always go to a destination, right? So the similar way, whatever the fluctuations in the market, you should just continue your disciplined SIPs, STPs going into your portfolio, right? Only when the goal approaches, you have to look at coming out and doing what is required at that point of time. So that is very important. Now let's look at one practical example. Let's say, so these are the points of Nifty 50's all-time highs, the HHH, whatever I've written. So over these years, these have been the all-time highs of the markets, right? So what happens if I keep on investing 10,000, 10,000 at all these peaks, all these all-time highs? I choose to put 10,000, 10,000. So what happens is I keep doing that over these periods, and you see that the markets are like volatile in the short run, but in the long run, the trend is upwards only, right? Even if I have invested in the all-time highs also, my average return throughout this period will be about 11%. So which is not bad. Our inflation itself is in the range of 6 to 7%, and 10%, 11% return is very good. So even though your STPs or SIPs tend to go when the markets are doing good, and they also tend to go when the markets are not doing good, because you have set off on that journey. You are not stopping or restarting or not doing anything of that sort. So even then your returns will be good. So the best time to do is to have patience. Once you have set off on the journey, unless and until otherwise there is a drastic change or threat in the internal fundamentals of the fund, only then one should look at doing any necessary changes. If the fund is a stable one, if things are as per your plan, and as you have set off on this journey, you should just continue and let it be. So investing mistake number 4 or 5, this is like stopping SIPs during correction, right? So please don't do that. When market correction happens, yeah, people tend to that is an emotional human behavior, right? So people tend to get panicked, and they feel that I should stop or something. So just keep going, continue your investments in a disciplined manner. Last but very important these days is people following advice from social media. One thing I can say, maybe because it is free and it's trending, or it's viral, so people tend to follow, advice from social media. It is very important to understand who are these people advising on, so many things. Are they experts in their field? Okay, and what they are advising to you might not be suitable as per your financial goals, as per your risk profile, as per your financial status that you are in. right? It might not be suitable. They are talking maybe on behalf of their experience or wherever little bit reading they have done. So not all advice is, okay to follow, is what we are trying to say here. Be very choosy, be very careful. See, when you go to buy a sofa or anything for your house, how much do we evaluate, right? So we go to three, four shops, we check the quality, we check the pricing, and then the best price, the best quality, we do that. So why don't we do that for everything in life, right? Just because it is free doesn't mean that it will help you, right? Sometimes you have to take that bet. For example, let's say over the counter medication, is it advisable? Take Google is there for everything. So doctors, most of the doctors we stay we see that they're educating us like not to take advice from Google, because sometimes what happens, people take do Google and do take all the medication, and they become worst of the worst situations, and then they go to the doctor. Will educate them not to do that, right? So, like how we pay consultation fees and go to a doctor and to take proper advice and guidance from them, there is nothing wrong to pay a little money to a good advisor whom you can trust and who can help you with a lot of things, who is an expert in the field, who knows in and out, because every day that is their job that they do, they're qualified. So, there's nothing wrong if you have to spend some money once in a while to get it reviewed from a portfolio manager. So, do that instead of following advice from social media, because we don't know what the background is of that person, from where that advice is coming. Some days back, I'm sure if you are active on Twitter and LinkedIn, you would have seen a video of a man speaking about FDs. Like he literally like talks about, let's say I'm splitting my FD in 10 different banks who are offering 6% return. Let's say I'm splitting my 100 rupees into 10 banks. I'll get 6% on every bank, and my returns are 60%. Like, how is that even possible? And there are people who are taking, he is misguiding literally, and there are people who will fall for that advice, right? So that is the kind of world we are in today. So we have to be very cautious and careful. So the bottom line of whatever we have discussed in our first part and the second part of our webinar is discipline and goals. If you have a discipline, it will help you achieve your goals faster also. So have a disciplined approach. Do not panic, and please feel free to talk to people or advisors who can help you make better and informed decisions. So that is there for today. So these are the key takeaways. First thing is discipline is the key. If you have a over concentrated or over diversified portfolio, clean up your portfolio or de-risk your portfolio. Take that step today to do that, and focus on risk adjusted returns. Getting a superior risk adjusted return is important than getting a high return. 20%, 19%, they all look good, but what is the risk you are carrying in your portfolio? That is also very high. If something happens and markets don't perform, you tend to lose out so much as well. So look at the other side also. So risk adjusted return means for the level of risk that you are taking in your portfolio, are your returns appropriate? So that study, that evaluation is very important. And investing without goals is like shooting in the dark. Always have a goal based plan or a goal based investing approach, which will help accomplish everything. It will keep you 360 degrees protected, whether it's your risk management, loan management, whether it is your planning and goal management, everything will be taken care. So time in the market is very important. So please be patient, be disciplined, and spend more time. Let your investments stay in the market and reap that kind of a benefit for you. So those are my um, knowledge and my experience today that I have shared with you all. I hope you like the session. So if you need any help, a one-to-one consultation for a second opinion, please feel free to get in touch with us. So my name, number, and email ID is there on the screen. You can get in touch with me. We are open for questions now. So
Thank you very much, ma'am, for sharing the valuable insights. We are already having the questions in the Q&A section. Meantime, I would like to request participants to post your questions, and if you are having any queries, we'll be taking it.
yeah, so there are like a couple of questions. So Mr. Deepak Asopa has asked, can we start creating wealth after 45 with zero level? This question is half, I feel, Mr. Deepak. If you want to unmute and speak, we can, take your question.
No, I think we are already having one or two questions in the Q&A section. We can take it.
Okay, okay. So yeah, start creating wealth after 45 is zero level. I didn't quite understand that, but let me explain. So after, so like I said, you can start, having your starting your investments or starting creating wealth after 45 with whatever surplus you have. Maybe you can look at what assets you have, and if you are able to pull out some of it and create a portfolio of, equity mutual funds or stocks, or let's say other asset classes, and also start putting your monthly or annual surplus into those asset classes to create wealth. Yeah, there's nothing wrong. You can do that even if one is 45. We can definitely do that. So Rohit Gupta is saying the whole world is going towards recession and India is at all-time high due to FII investments and VII are taking back the money. Don't you think investors should be cautious and we might see a fall at least 10 to 20%? You should understand that the global recession, India is not immune to global recession. India will be impacted at to a certain level. But what the investors are seeing potential in India is the downside risk in India is much lower than the downside risk in other countries. So that is why the FII investments are flowing towards India, because the decisions of the government, the growth prospect of Indian companies, industries, and all, the demand for our products and things is looking very positive, and that is why they are coming and investing. Market fall and rise, it's a part of the ball game. We cannot say that markets will always go up from now onwards. We don't know. Like I was saying in my timing the market thing also, nobody knows how the markets will respond and react. It is something very subjective and something very, very dynamic. Anything can happen, which might, one small news also can make the market come down a little bit, and again there will be another news or another good thing happening, and it will again start rising and things like that. This keeps on happening because it's a market cycle. So investing should be something like which is done on a consistent basis over a period of time and in a very disciplined manner. So we cannot exactly time the market. So how important, Archit is asking, how important is it to book profits and shift profits into buying real estate? Yes, you can book profits and buy a real estate, but overdoing real estate also is not helpful. So what is the allocation of real estate one should have in the portfolio? See, your financial assets. Now, what is financial asset? Financial assets are your, liquid financial assets, which can be converted into cash easily, right? What are those financial assets? Your equity mutual funds, your shares, FDs, debt mutual funds, all of these are your financial assets. Real assets are like gold, physical gold. Your real estate is also a real asset. So what is the ratio of real asset to a financial asset is your real assets should not be 30 to 40%, more than 30 to 40% of your overall asset size. Let's say you have a 1 crore, of total assets, all assets put together, you have 1 crore. Then your real estate should be about 30 or 40 lakhs only, right? Others 50-60 lakhs should be in your liquidable financial assets. So that is one example. So now booking profits, if you have a good real estate opportunity, let's say, okay, where you feel that there's a potential for me to invest and it is going to capital appreciate, so then you should also look at what existing real estates you have, whether you're adding more to the real estate basket, because real estate is locking the money in that asset for a very, very long period of time. We don't know how much, and the rental incomes are taxable, and the rental yield is not great throughout India, if you see. So you have to consider all those aspects. So maybe you can have a one-to-one consultation and see, we need to understand a bit more on other aspects, and maybe then we can advise on that. What is the best time to invest? How to know? Shekhar is asking. Shekhar, that is exactly what I explained in today's investments. So whenever you see, whenever you have a surplus in hand, right? So always make sure that you keep something in cash, some amount in cash, where you're looking for opportunities to enter the market or invest in the market. So when is the best time to invest? I cannot pinpoint and say with number wise, but whenever you see a decent correction, okay, correction in the markets, that is when you should go and put a lump sum, into the markets and invest it in some good assets, good mutual, let's say mutual funds, in some good quality mutual funds. If you're investing in some stocks, identify which are the stocks you want to invest, like large cap, mid cap, small cap, whether mid cap and small cap will be doing good in the next 4 5 years. So you should invest in those stocks when the markets are correcting. So you should invest in such identified mutual funds when the markets are correcting. So there is no best time. What you can do is at every correction, you try to put a little bit more than what you normally do. So then there's continuity. So we always do that. We tell our clients also to keep something in surplus or maybe keep something in liquid mutual fund, so that when we see that there is an opportunity when the markets are correcting, and when we see that, we get a lot of research backed inputs, right? So whenever we see an opportunity, we can deploy that fund for you. So something like that. So we cannot exactly time or say in number wise how much, but you can look for opportunities like that. Yeah. Archit is also asking, can wealth be created by investing in equity only, and within equity, small and mid caps? What are the other asset classes to create wealth? See, equities has been one best asset class to create wealth. There is no doubt about it, right? So, but down the line, especially when Corona hit and the markets were so volatile and people have suffered a lot during those times, it makes sense to have other asset classes also which are not correlated to equities, right? For example, that is what I explained initially: over concentration, asset allocation, and over diversification. That you should add avenues like gold or debt mutual funds or FTs in your portfolio, so that when your equity markets are not performing, you have these asset classes from where you can pull out, or these asset classes perform when the equities are not performing, so that your returns are also not looking bad in those years. So wealth can be created with the best combination of asset allocation, is what my answer will be for your question. You can feel free to call me or reach out to me on WhatsApp, if you have anything to discuss in this manner, so we can have a discussion. It is easy to identify market peaks and bottoms in the hindsight, but how can one identify it before the market run or crash? So this is a very tricky question, and I'm sure there's no sure short answer for this. But what most researchers do is they keep reading a lot. They keep uh, research is the key for all of this. So keep reading, keeping an eye on the what is happening in the market. What can come up. So all that maybe can help you identify. When it is going to peak out or anything. Markets as a whole, it is, I think, difficult to identify that because markets are more depending on human behavior, like what investors feel, and what is the trend, or how the markets behave. It's totally out of control that we cannot identify that. But in one particular fund or in one particular stock, maybe you can identify these things with some fundamental and technical research and analysis. There is a possibility, slightly. Yeah. SEBI has put some guidelines for financial influencers. How do you see the initiative by SEBI? Yeah, this is very important. We felt that whatever content is going out and on the social media today, whether it is YouTube, Twitter, or LinkedIn, or wherever it is, so SEBI is going to have guidelines or a strict kind of a thing going forward. So this is very good because this will help people not to just follow the advice that is given and to protect the investors, to protect the people out there. So that's a very good move by SEBI, and we are really we feel good about it. Yeah. Nikita Shah is asking, while looking at the current market level going forward, what would be your recommendation to the prospects to invest in which category of schemes? Debt category, multi-asset, large cap, flexi cap. Yeah, Nikita, if you have, if you're there throughout the session, I have always mentioned of adopting a asset allocation strategy, which is based on your age and based on your goals. Uh, you know, an advisor can help you identify what is a good mix, what can be a good mix for you, how much in equity and how much in debt, and within equity how much in large cap, flexi cap, and small cap, and will mid cap and small cap help you better, or is it large cap that will help you better? In debt also, what is that category you should be looking at, how much of a gold investment you should be looking at? So it is like that. So this needs a consultation. Maybe you can reach out to us. What part of our portfolio should be in hybrid funds for long-term portfolios? This is a good question, Rohit. So hybrid funds are, a good mix of, debt and equity. So what is the allocation you can look at is about 5 to 10% for hybrid allocation. Is multi-asset allocator fund good, or should we directly invest in sovereign gold bonds and debt funds? See, multi-asset allocator fund, in some cases, it will help where people don't have the time and effort to, do it themselves, right? But if you are able to spend time and, buy the SGBs, SGBs are really good. We recommend going for, gold allocation in SGB. Or alternatively, you can look at gold fund of funds. So that is that. So yeah. So I think I've taken most of the questions, Sanjay. Just let me just go through. I'll just scroll and take a few more maybe. Yeah, there's one more question. Can we invest in IT and pharma now for the future? Is pharma IT index or in okay? So sector allocation, actually, it's not advisable because, especially the pharma sector, because it is cyclical in nature. So best is to go for having instead of targeting sector wise, it is better to go whether large cap, multi cap, mid cap, small cap allocations like that. IT sector, we cannot say because globally, Indian IT is depending more on global opportunities, right? So if global opportunities will take a long time to revive and recover, the businesses also will have a lag in their businesses. So we need to consider those aspects. So that is why it is better to have a very, very small allocation, like let's say 1 or 2% in sector allocations, rather than, but having a good mix of asset allocation will help you. How to decide when to exit for any mutual fund? So this is asked by Mangesh. Yeah. Hello, Mangesh. See, when you see that your principal amount has grown, to, let's say, it has doubled, or let's say it is going to double, where you can see good amount of profit and the fund has been consistently performing for a certain period of time. That is when you should decide, to book some profits out of it. You must not think that, okay, it is doing well, let it be. I'm not saying book entire profit like that. Maybe a partial profit booking will help in that case. Yeah, I hope I've answered that. Yeah, I've taken most of the questions, Sanjay. There are few more questions. Okay, I'll take the last one because this is something related to gold. Swami is writing, when we do lump sum investment towards a goal, STP is better or directly investing in the funds is better when we do lump sum investment towards a goal. See, Swamiji, see, the thing is, whenever in equity markets, doing a lump sum investment is always risky because the cost at which we will be buying, we don't know whether in the future it is going to go up or go down. So, to average out our cost price so that our returns are much more efficient, what we do is we always suggest to go for the STP mode only, and especially if it is towards your goal. When we are investing for a goal, we want to target a specific return required rate of return. So in order to achieve that, our cost should be averaged out, right? And STP is the best way to average out the costs. So always don't do a one shot investment, unless and until it is a very very steep correction, like what we saw in 2020 due to COVID. If it is a steep correction like this, until and unless, but at that point of time it was so what do you say, uncertain, and we were not able to understand where the markets will go and all. So STP is always a better route to take. That will average out your costs. Your returns will also be consistent with your risk.